All right. So thanks everybody for being here. We're going to talk about taxes today, specifically year-end tax moves. Let me get my presentation going here. All right. And during the presentation, if you have questions, like Caitlin said, feel free to pop them in the chat and she can answer a lot of things, or we can answer them at the end, whatever works for you guys. So let's get started. So my disclaimer, this is not personal tax advice. This is for educational purposes only, and you should always do your due diligence for your own personal situation. All right, so before we get started on the year-end tax moves, I'm going to talk about the 3 income tax buckets, which I think a lot of you have seen before, but these are really the foundation of tax planning. And this was really the big light bulb for me for understanding my own taxes and my tax planning. So let's take a quick look at what goes in each of these tax buckets. So this is how the IRS sees your income and how they divide up your income. And for the most part, these are discrete tax buckets, right? So you're not really able to combine income and deductions between tax buckets. So if you have a lot of W-2 income, but you have a lot of real estate losses, in most cases, you can't combine those together. And that was just a huge light bulb for me, right? Because I, a few years ago, did have that situation and I couldn't understand, well, why are these things not offsetting each other? It's because the IRS views things in these discrete tax buckets. So we have the first one, the red one over here. That's your active income, also known as earned income. And so that'll be your W-2 income, your 1099 or hourly income. If you are running your own business that runs through your own tax return, like on a Schedule C, that'll be over here as your active business income. If you're running an active short-term rental, so you're running your short-term rental as a small business, that'll be over here in this bucket. If you're an active house flipper, typically that'll be over here in this bucket. Roth IRA contributions, because that is, salary essentially, and 401k withdrawals, because that was salary in the past, right? So that's your active income. And so if you have a lot of that type of income, you're going to want to look for deductions that offset that particular type of income. In the next bucket, we have portfolio income. So this is what typically people think of as like their paper portfolio. So this will be if you've sold stocks or bonds, if you're getting dividends, like from your stock account, if you're getting interest from your different accounts, if you've done owner financing and someone is paying you interest payments, that'll come in this bucket. If you're in private debt funds, and that's different from private equity funds. So private debt funds, you're funding the debt of either like real estate or a business. That typically comes in this portfolio bucket. And then sales of non-business assets. So if you have something that hasn't been a part of a business that you're doing, say you have a collectible car, right? And you're selling that and making a $20,000 profit, that's where this will show up as your portfolio income. You may also see this if you're selling your house and you've made more than the capital gains exclusion on your home, that extra income will also be here in the portfolio bucket. And then lastly, we have your passive income bucket. So most rental real estate is going to be over here in this bucket. So this will be your long-term rentals, your short-term rentals if you're using a property manager, real estate syndication income. So these would be like private equity funds. So if you've bought into real estate and different types of assets, might be multifamily, car washes, whatever, that'll be over here. And really any passive business or rental income that's reported to you on a K-1 would be over here. All right. So this is overall how tax planning works when you're using these 3 tax buckets. So you look at where your income is coming into, and then you pair deductions that match that type of income. And this really is the key to getting your tax bill way down, right? You hear a lot of people throw out all these different terms all the time. Oh, you should do tax loss harvesting. You should do a 1031. But if you don't understand where your income is, you don't really know which of these things you should do, right? should I be doing this? Should I be doing that? Well, it depends on what type of income you're trying to offset. So that's why this is so powerful to finally learn and understand how your tax buckets are set up. All right. So now that I've laid that foundation, I'm going to talk about some year-end tax moves for 2025. And then we're actually going to take a look at how you can use these in your tax buckets to get your tax bill way down. All right. So the first one is the timing of charitable deductions. And this is a special thing for 2025 and 2026. So the One Big Beautiful Bill Act, hate that name, OBBBA, I'll just call it the New Tax Act, has changed things a little bit. But unlike a lot of other provisions in the bill, the charitable giving provision isn't changing until 2026. So for 2025, things are staying the same. So typically right now, if you take the standard deduction, you cannot deduct any of your charitable contributions. If you itemize, you can deduct typically the full amount of those charitable deductions. So this is changing for 2026. 2026 is now going to allow you to take a charitable deduction, even if you're taking the standard deduction. And so that deduction will be $1,000 if you're single, $2,000 if you're filing married, filing jointly. And if you itemize your taxes, the amount that you can claim for your charitable giving is going down in 2026. So the first 0.5% of your AGI will not be counted anymore, and the amount that you can give is capped at a 35% tax rate credit. So if you typically take the standard deduction, and so if you're like me, right, you get to December and you're like, crap, I haven't done any of my charitable donations for the year. I need to donate a bunch of money. So if you typically take the standard deduction, you might actually want to wait until, say, January to make that contribution so you can claim it against this new $1,000 or $2,000 tax deduction that you're allowed to take. If you typically itemize, you might want to front load your charitable giving here in December for 2025 because you're going to be able to claim more of it. So it's just something to think about with the timing of those two things, whether you want to give in 2025 or 2026 or both. All right.
Susan, I'm sorry, it's Amy. I have a question.
Are you on the beach?
I am on the beach.
I am so jealous.
I moved from a stairwell to the beach. Isn't that an upgrade? Yeah. It was funny as we were talking about our cold weather conversation at the beginning because it was cold at 50 degrees for me this morning, but now it's sunny. Okay, I've been thinking about this question for like 2 days because I've been embarrassed to ask it, but I decided that one of the things I'm doing in my life now is doing things I'm scared of. So I'm going to ask the question. How do I know if my CPA, if I'm itemizing or taking the standard deduction? Because I send a list of things to my CPA and then I don't look at my tax return. So can you help point me in the right direction to look at my tax return or ask my CPA to learn if I itemize or take the standard? I don't know how to find out.
Yeah. So typically, if your Schedule A is filled out, you're itemizing and you will see your deductions on Schedule A. If you're just taking the standard deduction, you won't be taking those deductions. Yeah. And it may change depending on how your tax situation turns out every year. So if you're using a software like TurboTax, it actually looks at what you've put in as your numbers and says, okay, you should itemize or you should take the standard deduction. And that's essentially what your CPA is doing too. And it could change year to year. And I'm actually going to talk about this with this new SALT cap being raised. It's going to change things for a lot of people, actually, I think.
Okay, thank you. That was helpful. So if I look back at my taxes from 24 and I see a Schedule A, that means that I'm itemizing. And I could just confer with my CPA that the plan is probably going to be the same for 25?
It depends.
Okay. Okay. So how do you know ahead of time if you're going to, I don't want to take us too off task here with the main presentation, but maybe if there's time, you could answer the question at the end. How do I forecast if I'm going to be itemizing or using the standard?
Yes, and that is something we're going to look at when we look at the buckets. Great. Because once you put your information in the buckets, you should have a pretty good idea of whether it makes sense to itemize or take the standard deduction. And like I mentioned with this salt cap, so salt is state and local taxes, right? And so typically, up until this year, there was a $10,000 cap on that. So for a lot of people, they may be paying a lot more than that in property taxes and state taxes, but all they could claim was $10,000. And so in a lot of cases, it made more sense to take the standard deduction. This year, the salt cap has been raised to $40,000. And so this is going to change, like I said, this is going to change things for a lot of people, including me personally. Um, and so if you're single, the cap is 20,000. If you're filing jointly, the cap is now 40,000. So what this allows you to do now is potentially write off your state and local taxes, and then you can itemize and take your other deductions. So the bundling is another sort of layer on top of that, right? And so, and you have to see whether your jurisdiction allows you to do this. But here in Travis County, Texas, where I live, you have the option of paying property taxes in December or January for the previous year, right? So for 2025, I can pay my taxes right now here in December of 2025, or I can pay them in January of 2026. And so this gives me the potential to bundle 2 years of property taxes together into one federal tax year, right? So I can pay my 2025 taxes in January, and I can pay my 2026 property taxes in December of next year and bundle those together. So for me, my property tax bill is about $21,000. And so I could bundle those into 1 year, take the $40,000 cap on those, then also put in my mortgage interest, which is, like $15,000, charitable donations, if I have any high medical expenses. And then at that point, I'm way over the standard deduction, right? And then I've got this like massive deduction that I can take off of my taxes. And so if you're doing the bundling, you would bundle for a year and then take the standard deduction the next year and then bundle again the following year. And this can be a really great planning tool, right? To give you a big deduction in certain years. Like if you know that you're getting a big bonus or you have some extra income coming in, that's a great reason to bundle the state and local taxes if you can. And even if you're not doing the bundling, it may be the case now if you live in a state with high state taxes or high property taxes that you may want to itemize moving forward. So say in my case, right? So I've got a $21,000 property tax bill, $15,000 in mortgage interest. That already puts me over the standard deduction for a married couple for this year, right? So I will be itemizing no matter what, whether I do the bundling or not. Itemizing makes more sense for me now. So that is definitely something to think about. There is an income phase out if you're making over $500,000, but otherwise you're eligible until that point for the entire cap. So this is something that's going to change a lot of people's taxes and can really help you out in your tax planning if you start to think about this now.
Susan, two questions on that before we move on. One, I know a lot of folks have mortgages and their taxes are escrowed. Are you still able to bundle when you're escrowed?
That is more challenging, yes. But if you have, I think it's 20% paid into your mortgage balance, you can request that you no longer escrow. And that's what I did. I just sent a request to my lender and said, hey, I don't want to escrow anymore, and did the paperwork, and it was fine. Yeah. So that is something you'll have to think about because typically you don't have control over when your mortgage company is paying those property taxes.
Yeah. So that's a good thing to make sure that you're getting on top of if you're trying to do this on a property that is has a mortgage and the taxes are escrowed, which adds, kind of another layer of something to do for your property, but also it gives you more flexibility and control. And it is kind of nice to have that control of timing as far as when you pay, whether you're bundling or not. And then we have another question about bundling too from Monet. If joint income is greater than 500,000 and you're itemizing, does bundling matter?
it can still work for you, but you have to see where that phase out is. So it's not a cliff at 500,000 for the cutoff on the salt cap, but it does start phasing out. So you'd have to see, like, if you made, $505,000, you still would get to take most of that salt deduction. But if you make, $800,000, you might not get to take any of it. So you'll have to look and see where you fall on that income scale and see if that still makes sense for you to do that or not. All right. The next thing is bonus depreciation. I think we're probably all somewhat familiar with this, being in real estate. So this is back again. It was on the decline. It was declining 20% every year for the past few years. At the beginning of this year, it was at 40%. But with the new tax bill, it's back up to 100% for anything you bought after, I think it was January 19th of this year. So what this allows you to do is when you are purchasing a property and putting it into service, you can depreciate pieces of the property on a faster scale than the standard depreciation. So standard depreciation on properties is 27 and a half years for residential property, 39 years for a commercial property. But there are pieces of these properties that wear out faster than that, right? So that's sort of just the overall time period that it's saying for your property, things are going to wear out. But there are things inside, like say the appliances, the flooring, the ceiling fans, things like that, that actually wear out faster. And you do get to accelerate that depreciation. So there's 5-year items, there's 7-year items, and there's 15-year items. And 15 years typically landscaping items. So what bonus depreciation allows you to do is to take all of those faster depreciating items and depreciate them all up front in the first year and take typically a pretty big deduction on your property the first year. And so this can be really helpful if you're trying to offset a significant amount of income coming into a particular bucket. So typically, like I said, most real estate's going to be in the passive bucket. So if you have a lot of rental income, you sold a property in a particular year, typically you can use bonus depreciation against those gains, right? So it might be a good tax planning move for you to do that. And to separate out those items, you would do a cost segregation and then combine them all together and do bonus depreciation. It can also be useful for your active tax bucket. So I had mentioned short-term rentals that you're actively managing can oftentimes be classified as an active business if you meet the criteria. And so this is another great way to get a big deduction in that bucket if you have a lot of, say, W-2 income that you're trying to offset for a particular year. You could do bonus depreciation on your active short-term rental and offset a lot or maybe all of that W-2 income. And it does carry over if you don't use it all at one time. So I bought a cabin, so it was 3 years ago now, and I did bonus depreciation. I got $160,000 write-off from that bonus depreciation. So it can be a significant amount of money. And we were able to write off a lot of the W-2 income that we had that year, which significantly decreased our tax bill. So this is another really great tool to keep in mind and keep in your toolbox.
And Susan, I have a question that I wanted to bring up that we got in the chat too. Often we talk about bonus depreciation from the perspective of investment property, but when it comes to our vehicles, if we're using our vehicle for business purposes, we also have the option for depreciation. Can you talk a little bit about that?
Yeah. So like Caitlin said, it has to be typically business use, and you have to use it for business more than 50% of the time. But you are able to write off some of your vehicles that are heavier. I think it's, what is it, Caitlin, over 6,000 pounds?
Yeah, I think that's still the number.
Yeah, you can write off up to 100%, but vehicles that are lower than that, and a lot of people don't realize this, vehicles that weigh less than that, you can actually still depreciate up to a certain amount. I think last year it was like 22,500. So there is the potential to do that. And that's something I've also done with two of our vehicles. Um, so you can get a good write-off from cars. And also, you can depreciate almost any tangible thing. If you buy equipment, if you buy a tractor, things you're using in your business, a lot of times you are able to depreciate them. You can also do like a Section 179 write-off that would, in a lot of cases, serve in a very similar way to bonus depreciation, where it would allow you to write it off all up front. And there are a lot of different nuances and rules around that. But that's another thing to keep in mind, because it does work very similar to bonus depreciation. And technically on your taxes with bonus depreciation, you are supposed to take bonus depreciation. You actually have to opt out of it on your taxes. So if you don't want to take it, there is a box that you have to check and say, I'm not taking bonus depreciation. But it's a powerful tool, and that's why it is the default on the taxes, right? Because most people want to take it and get that write-off up front. It's the time value of money, right? You save $30,000 on your taxes this year, you can go ahead and get that invested and start growing those funds rather than paying them to the government. And then there may be a tax bill down the road for depreciation recapture, but there are different ways to keep kicking the can down the road with that, because you can always keep taking more depreciation even when that tax bill is coming due, right? You can take depreciation on something else. You can do a 1031 exchange in real estate. And so a lot of times what these investors will do is they take the bonus depreciation and they just keep kicking that can down the road, and they end up eventually dying, and everything passes to their heirs without them ever having to pay that tax bill that they were deferring. So it's a pretty amazing tool for building generational wealth.
And one clarification on there, well, actually, maybe a couple of clarifications. One is that if you're depreciating an asset, that depreciation will go in the bucket for which that asset was used, right? So if you have a certain type of business that is generating active income, that depreciation would then come out of that active bucket. But if you're using it for the purposes of a business that is generating passive income, then that depreciation would come out of that passive bucket. And then another nuance, which sort of goes back to that conversation about Section 179 versus depreciation, is if a business actually purchases a vehicle, and then you are also interested in taking depreciation on that, that's kind of a nuanced situation. So I just wanted to make sure that was a follow-up question, and I wanted to make sure that we could share the answer to that.
So your question is, if the business purchases the vehicle?
Yes. So then can the individual, as an owner of that business, then take that depreciation?
It depends on the structure of the business, but usually yes. If it's flowing through your own tax return, so if you've got a sole proprietorship or an S corp, then yes, it will flow through to your own tax return. If you're a C corp, then no, that asset belongs to the business. So that's how that works. And if you do take depreciation on your vehicle, once you've taken those actual expenses, so depreciation is counted as like an actual expense, you have to continue taking actual expenses on your vehicle. You can't take the standard mileage rate. A lot of times people do the standard mileage rate because it's simpler. I think last year it was like 67 cents a mile. If you're going to deduct actual expenses, instead of taking the standard mileage rate, you're going to deduct, whatever business percentage of your gas, your insurance, your maintenance, your registration, things like that. And so that is something to think about when you're deciding whether to take depreciation on a vehicle or not, because you are stuck taking actual expenses for the rest of the life of the vehicle. All right. And then the next thing to think about is your withholding, right? So we're in December now. So we're right pushing up to the end of the year. Now is a really good time to look and make sure that you have withheld enough for taxes. A lot of times people find that they are under withholding because their original withholding form their W-4 was based just on their income, and they may have a spouse that's also earning a lot of money that's pushing them into a higher tax bracket. Or you may have had side income that you haven't been paying taxes on, like a lot of rental income coming in or a side business, and you haven't been making quarterly payments. So you may find here at the end of the year, oh crap, I haven't paid enough. And now is a really good time to make that last quarterly payment. So you won't get a penalty when you file your taxes. And then another thing to check, of course, is your retirement contributions to make sure that you've contributed the amount that you wanted to and that you haven't gone over any limits. There's still time right now if you've contributed to a Roth IRA and then you realize, oh, I made too much money, I wasn't actually eligible to do that, you could still pull that back without a penalty. So this is a good time to check all of your numbers and make sure that everything looks the way that you were expecting it to look. All right, talking about IRAs, this is also the time to finalize Roth IRA conversions. And this is when you are converting money from a traditional IRA and moving it into a Roth IRA, and you will pay taxes on it at that point. What a lot of people don't realize, and this catches them by surprise, is that your conversions, your Roth IRA conversions, have to be done by December 31st. Your Roth IRA contributions can actually be done until April 15th for this tax year, for 2025. But those conversions have to be done by December 31st. And so that does trip a lot of people up. So you want to go ahead and see how much income you have for the year. It should be a pretty good estimate at this point, because we're almost to the end of the year, and see if it makes sense to do a Roth IRA conversion. And you would want to do these in a year where typically your tax rate is a little bit lower for some reason. So say you were out of work for half the year, you're going to have a lower tax rate this year. This will probably be a good time to do a Roth IRA conversion, and you can convert that money at a lower tax rate than you would normally, right? Or if you're also trying to fill out the rest of a tax bracket. So say you're in the 24% tax bracket, which actually is a great tax bracket to be in. It's a big, wide tax bracket. Next bracket up is 32%, so there's a pretty big jump after it. But, you know, if you're solidly in the 24% tax bracket, you might want to do a Roth conversion, you know, to fill out more of that bracket at 24%, because it's not going to bump you up to another bracket, right? So different things like that are what you want to think about when you're looking at whether you should even be doing a Roth IRA conversion, and you want to make sure to get it done by the December 31st deadline. I'd recommend starting it probably a week before that, just to make sure all the money moves in time. All right, another thing to think about is taking RMDs, your required minimum distributions from your own or beneficiary retirement accounts. I don't know if we have anyone on this call that's taking RMDs from their own retirement account yet, but probably beneficiary retirement accounts, those would be common even in younger people, right? As they're inheriting them from their parents or other relatives who've passed away. Those have to be emptied within 10 years. So don't skip taking those minimum distributions, because you can have a big penalty and or a big tax bill if you wait until the very last minute to empty that retirement account. All right, tax loss harvesting. This is also the time to be doing that. So tax loss harvesting is typically done in your brokerage account, and you will sell things that you have a loss on and buy immediately back into the market something different. You can't buy the same thing, or it's a wash sale. But this will generate a paper loss, right? So say, you know, I bought Apple and now it's gone down $10,000. Well, maybe I'll sell that loss and lock in that loss on paper, but I'll buy back in one of these other tech companies, right? And so I've got the same exposure to something very similar, but I've locked in this paper loss of $10,000 that I can now use on my taxes. And so you can do this to offset capital gains that you have for the year. So if you've sold stock and you've gotten capital gains, you can offset that with these paper losses. You can also offset up to $3,000 of earned income So typically you'll see most of your tax losses in that blue bucket, the portfolio bucket that we talked about, but you can actually move $3,000 over to the red bucket to offset W-2 income. And a lot of robo advisors, or if you're using a financial advisor, they will actually be doing this for you during the year. So that's definitely something to check out if you are using one of those services, to make sure that they're doing this for you. You can also do it yourself by hand. I know a lot of people that go back and forth between like a total stock market index fund and an S&P 500 index fund. They're very similar in their exposure to the market, but they are technically counted as two different products. And so they'll go back and forth during the year, generating losses between the two of them and moving money. You just have to wait 30 days before buying and selling the same thing.
And on that note, there's a 30-day look back too. Sometimes what trips people up is dividend reinvestment. So if you're in a dividend reinvesting program with one of your funds, make sure you just turn that off for a fund if you're looking to do some harvesting, some loss harvesting there, because that 30-day wash sale, it also applies retroactively. So the IRS will actually look to see if you've made a purchase in the past 30 days on that particular fund, and a dividend reinvest qualifies as that purchase. So that's something that is recommended that you just turn off. If go to give it a double check if you're thinking about doing a tax loss harvest. Make sure that you're not reinvesting dividends for this 60-day time period.
That's a really good point, Caitlin. And it actually, that tripped a lot of people up back in April when the market fell a lot, because these stocks that were doing quarterly dividend payments, which is pretty common, had just paid out, right, for quarter one. And so a lot of people were doing their tax loss harvesting, and then they got hit with the wash sale rule because those dividends, those quarterly dividends, had reinvested automatically. And so that is definitely something to watch out for.
And Susan mentioned gains harvesting as well. I just wanted to highlight it again because gains harvesting can be a really strategic move. Again, just kind of like a Roth conversion, if you're in a period where you've just had a tax year of lower income, you might even be in a cap gains bracket of 0, or maybe you're going to be in one of the lowest cap gains tax brackets that you expect to be in. If you're going to be living off of your portfolio at some point, which I would imagine everybody is who's building a portfolio, and you want to kind of capitalize on the gains that you've had so far, you can do the same thing, and there's not that same wash sale rule. So you could go ahead and sell positions that you have where you've had a lot of gain, and you can buy them right back. And that will be, resetting your basis so that you don't have such a big tax liability down the road when you go to sell and use those assets.
Yeah, and we'll get to see some more of that when I show the tax bucket examples at the end. I'll show you how you can use tax gain harvesting, like Caitlin is mentioning, especially if you're in that 0% capital gains tax bracket. That's a great time to do it. All right. And then the last one I have on here, choose an HSA eligible health plan. So we're in open season right now for ACA and for a lot of employers. Something new this year is that all bronze and catastrophic ACA plans are eligible for an HSA enrollment in 2026. So this allows you to make a tax-free contribution of $4,400 if you're single, or $8,750 if you are married filing jointly, and you have a family in 2026. So this can be really useful if you are trying to control your adjusted gross income, because this is an above the line deduction. So, we talk about different deductions, and so some of them are going to come off your adjusted gross income. And this is a number that is used when you're trying to qualify for ACA subsidies. some of these deductions that we talk about, like the itemized deductions, so, those charitable deductions, your salt cap deductions, your mortgage interest, things like that. Those are below the line deductions. So those are not going to come off your adjusted gross income. They will reduce your taxes. But HSA contributions are an above the line amount. And so this is going to reduce your adjusted gross income. And it also is triple tax advantaged. So you can put the money in tax free, and then it grows tax free, and you can take it out tax free if you're using it on health expenses. All right. Oh, and I guess I have number 9, which is go ahead and start your 2026 tax planning. So now is a great time to sit down and think about what you're going to be making next year, right? And if you are applying for an Affordable Care Act health plan, you are going to have to be doing this anyway, right? Because they ask you to go ahead and estimate what your income is going to be for next year, which is crazy if they ask you to do this, but it's how the system is set up. So go ahead and sit down and start looking at how much you expect to make in active income, in portfolio income, and passive income. And a lot of times you can use your numbers from this year as a starting point. Go ahead and plan how much you would like to contribute to tax advantaged accounts, like an HSA. You're going to put them in a 401k, an IRA, and start looking at other deductions that may make sense based on those tax buckets that you've put together. All right. So now we're going to get to the fun stuff, the tax planning examples. So I'm going to show you 3 examples of how these buckets work in tax planning to really reduce your income if you get them set up correctly. All right, so here's the first one. We're going to look at how you can pay $9,000 in tax on $240,000 in income. And typically, your income tax on that amount of income would be probably $35,000 to $40,000. So this is a huge deduction. So this is a couple, and they were making $200,000 at their W-2 jobs. They also had dividends coming in, qualified dividends of $5,000. They'd done some stock sales. They had made $20,000. And then they also had invested in passive real estate syndications, and they had made $15,000 on those during the year. So you can see that income here, and there's 3 different buckets. So over in the active bucket, they were able to max out their 401ks. So they both did that. They had children, so they were able to take the max family deduction for their HSA. And then in this case, they did what we were talking about with the SALT bundling. So they bundled their state and local taxes together in 1 year. They were able to hit that max of the $40,000 deduction for that. And then they took the $15,000 mortgage interest that they had paid. They'd also donated $10,000 to charity. So we got their active income down from $200,000 to about $79,000. And then over in the portfolio bucket, the qualified dividends, they're in the 0% dividend bracket at this point. So they're not going to have any taxes on that. And their long-term stock sales, they went in and did the tax loss harvesting to offset those. So they did $20,000 of tax loss harvesting. And then over in the passive bucket, we talked about the depreciation. So those syndications that they had invested in had gone ahead and taken bonus depreciation. So they were sitting on these passive carryover losses, right, that they could just keep on using against their syndication income every year. And so they had essentially no realized income in the passive bucket. And so overall, this got their tax bill down to about $9,000. And then on top of that, they get to take $2,200 per child off of their tax bill for the child tax credit. And that is an actual credit, right? So it's not a deduction like you see up here where it's deducting the amount of your income. that is actually a tax credit. So that comes off of your tax bill. So for 2 kids, they could take another $4,400 off of this, and then they're paying what, $4,600 in tax. So that's pretty amazing to pay that little tax on $240,000 of income. And this next example, even more impressive. This was a couple that paid $0 in tax on $465,000 of income. So they're making almost $500,000 and paying no tax. So one of the spouses was working a W-2 job. They had a pretty high paying W-2 job, making $200,000. And then they also were making money off of dividends. They made $10,000 in qualified dividends. And so this is a kind of interesting situation. And you'll see this a lot with real estate investors, where one spouse will be working a W-2 job and the other spouse will be managing the rental portfolio and considering it an active real estate business. And if you meet all the criteria, you can claim real estate professional status and say, okay, this is my business. This is what I do. I manage our, portfolio of 10 rentals, and this is my full-time business. And the IRS will count that, if you meet the criteria, as an active business, and that income and those deductions will move over to your active bucket. And so that's what happened in this case, right? So they had a bunch of rentals, and so they were bringing in about $150,000 in rental income. But they were also able to deduct a lot of losses on those rentals. And that's, the beauty of real estate, right? Is this depreciation and your expenses. You get to deduct all of this before you pay taxes, unlike a W-2 job where they take the taxes out first and then you have all your expenses. And so they were able to also take these big deductions, but now they're taking them over in this red bucket. So you can see overall, they had the $200,000 W-2 income. They had $150,000 in rental income. They had some extra money to do a Roth conversion. After they had taken all their deductions, they actually were in the negative in this red bucket over here. So they went ahead and did a Roth conversion at 0% tax rate. So the spouse with the W-2 maxed out the 401k, maxed out the HSA. They did a little bit into a limited expense FSA. So that's for like vision and dental care. They took their standard deduction, and then they also had losses on their rentals that they were able to take. A lot of that was depreciation. So a lot of it was paper losses. And then they also had invested in real estate syndications, which typically are passive. But if you are running an active real estate business, you can actually do a grouping election on your taxes to group all of your real estate activities together and pull them into one business. And so in this case, they were allowed to pull those losses from the syndications over into this business and also use them here in this active bucket. So that got them down to $0, the 0% tax rate. And then at that point, they also had this capital gains 0% tax bracket, which goes up to a little over $89,000 in this year. I think for next year, it's up even higher, 96,000 maybe. So they did 70,000, like Caitlin was talking about, of tax gain harvesting. So they had gains in their stock portfolio that they just went ahead and sold and bought back the exact same thing, because on gains, you don't have a wash sale rule. And they were able to go ahead and harvest those gains at a 0% tax rate. So they had that $80,000 coming in, but it was under the capital gains and qualified dividends 0% tax bracket. So no taxes having to be paid. And they had moved everything out of their passive bucket into the active bucket. So there you have it. They got $0 in tax on $465,000 of income. All right. And now we'll look at one more. This is how a lot of people who early retire set up their taxes. So you'll see this a lot. Even people who retire, oftentimes will set up their, like retire at a regular age, will set up their taxes like this too. So we've got them primarily living off their portfolio at this point, right? So they're early retired or retired. They don't have a lot of active income coming in. So they're going to start their tax planning by looking at their portfolio income and seeing what they can make in qualified dividends or long-term capital gains and still stay in a very low tax bracket. So in this case, the number was $126,033, which I will go through why it was that particular number in just a second. But in their passive bucket, they had a lot of rental income coming in, syndication income, so a lot of real estate income, but they also had, again, passive carryover losses coming in from depreciation, bonus depreciation. They were essentially just rolling that tax bill down the road. And so for them, their passive bucket was almost always zero because they always had losses to offset whatever income was coming in. And then over in the active bucket, they went ahead and used their standard deduction against a Roth conversion at 0%, right? So you do get that standard deduction. Active income is usually the best type of income to use it against. And so they went ahead and did $31,500 in a Roth IRA conversion at a 0% tax rate. So going back to the portfolio income, so how we arrived at that number. So in this year, the 0% tax bracket for qualified dividends and long-term capital gains was up to $96,700. And so that was going to be 0%. Then they also knew they had the child tax credit coming for 2 kids. So they could generate up to $4,400 in tax and get that zeroed out, right? So that was the final number for that was $126,033 in qualified dividends or long-term capital gains. And so that gave them a $0 tax bill. Now, the interesting thing about this, right, is that is just their portfolio income. That is not necessarily what they took out of their portfolio. So they may have taken $400,000 out to live off of, but the gains on that may have only been $126,000, right? So that you're not necessarily limited to that gain amount, right? You can take out more of your principal also to live off of and still have a low tax bill, right? So maybe they were, they're living the fat fire lifestyle, flying their private jet everywhere and paying $0 in taxes. And you can take depreciation on a private jet too. So this in the end gave them $0 on $407,533 in income. So you can do some really amazing things when you start setting out your tax buckets and moving things around in different places, right? But I think the key is really sitting down and figuring out, what do my buckets look like right now? Where is my income coming in? And what are the deductions that I compare against each type of income? All right. And I always want to say this, right? Tax strategy is just one tool in your toolbox. I think a lot of times we see a lot of tax professionals that come in, especially at this time of year, when people are starting to look at their tax planning and they say, oh, you need to buy a big car for your business, or you need to invest in oil and gas to get your W-2 income down. And they're pushing people to invest in things that don't make sense with their overall financial picture, right? And so I see people and they buy like, $150,000 Rivian to save $10,000 in taxes. And it was a car they didn't need, right? And so overall, that's not positive to their financial portfolio. Same with oil and gas. I've seen a lot of people invest in that because it has some unique characteristics that do let you take that depreciation in your active bucket a lot of times. But I have never known anyone that actually made money off of their oil and gas investment. Everyone has lost money. And so again, does it make sense to save $10,000 on your taxes to lose $100,000 of your portfolio? In a lot of cases, it doesn't, right? And so I think it's really important to not let the tax tail wag the dog. right? So your overall wealth building plan should look at, your overall goals, your spending and saving, your investing plan, and your tax strategy. Like they all work together in concert to make up your financial portfolio, right? And help you build wealth. All right.
Susan, I agree. That's a good slide to have in there. Because it's like, after you spend 45 minutes thinking about tax planning, you can you need to zoom back out to the bigger plan again.
Yes.
Yeah.
And I get, a lot of people really like, the idea of running short-term rentals or having, a big long-term rental real estate portfolio. And then, when you start asking them questions, they're not actually really excited about real estate, right? Like they don't really want to be in the hospitality business, but they've seen, oh, these great tax benefits, but does it really make sense for them? And the same is true with like starting a business, right? Starting a business gives you a ton of amazing tax write-offs, but not everyone wants to start their own business, right? And so it's really important to think about what fits in my lifestyle and what do I really want to be doing, right? And so we saw there in the last example, I mean, that was a very passive free lifestyle, still with a lot of income, right? That could have been in the passive bucket, all, passive syndication investments, all that income coming in. And then the portfolio is just kind of generating dividends and capital gains on its own. There's no job happening, right? And so if you want that kind of lifestyle, those are the kinds of buckets that you should start setting up, right? Maybe you want to have your own business, and then you start looking at, okay, well, I'm going to have all this active income coming in on my business, right? How can I take deductions? Maybe then it makes sense to buy a heavy car, right? So it's really nuanced in what makes sense for people and what their goals are, their ultimate goals are, right? How they should set everything up.
Yeah, I think a really good example of that most people get is like you don't want to have a kid to get the tax deduction, the tax credit,
Yes.
excuse me. Like there's so much more that goes into that is not offset. So yeah, I think that's a good point.
Yeah. Are you saying that kids cost more than $2,200 a year?
Oh, I'm saying what I'm saying is I have not figured out how to calculate the emotional cost and benefit of the children.
Oh,
Let
totally. And I
alone
think
the
a lot of people would
financial.
say that about short-term rentals too, like the
Yes,
emotional cost
yes.
of it too.
Yeah,
So,
like your newsletter about yeah, that's very true.
or an oil and gas investment or some other type of like I've invested in syndications that have caused a lot of emotional pain too, right? So you always
Mhm.
have to decide what is the tax benefit really worth this equation?
Yeah, yeah. This kind of reminds me how when we're doing our annual business planning, we always start with making our personal 3, 5, and 10-year goals. Like we write that down for 15 minutes and then we talk about what we want the business to do because we want the business to serve the life, not the other way around, to the best we can.
I love that.
Yeah. I think I'm still recovering from PTSD from when my short-term rental guest put the dirty diaper in my hot tub.
Oh
Oh
gosh.
man. Well, see, that's a combination of the short-term rental, the business, and the kid all in one hot tub. And
Yeah.
Yeah.
yeah, yeah,
I mean, not to say these are bad investment choices to make. There's a reason that we've made these investment choices, but just to make sure that you know what you're getting into and it's not simply so that I can reduce my tax bill. And I agree with you, Perlette. After saying in the chat, my oil investments are not really returning what they're supposed to outside of tax advantages. And I can say that about a lot of mine as well,
Yeah.
unfortunately.
Yeah.
thank you for the session. I have to hop off, but I just wanted to say thank you.
Thanks for
So,
joining, Amy. We'll
Yeah.
see you
yeah,
Enjoy the
soon.
beach.
bye. Thank you. Yeah, bye.
Bye.
Yeah, and thanks
So,
everybody for being here. But yeah, Susan, go ahead. I'll let you talk to. We've got more as far as tax planning goes. If this is something that you think you could use some more help with.
yeah, so I recently got my enrolled agent certification, which allows me to do more in tax strategy with clients and represent them in front of the IRS also. Um, so we've started offering a tax planning package. And so this is two 60-minute one-on-one sessions. So at the first session, we look at your tax situation and we discuss your tax goals. And we really, feel out what your buckets look like right now and what you might want them to look like in the future. And then I take all that information and I put all of it into your own personalized tax bucket plan. So, like you saw there with those three previous examples, we look at what your buckets look like now and then what they can look like in the future. And then we meet again for the second session and we go over everything. And answer questions. And then you have 30 days after that to send any more questions that come up after that. So if you're interested in doing it, I haven't really publicized this a whole lot. So this is kind of a secret offer, I guess. So if you are interested, you can scan the QR code and read more about it and get in touch with us. And we can help you out with that. I think that tax planning is so important, and it's something that your CPA typically is not going to do for you, right? So your CPA, typically you are just taking your numbers and you're sending them to your CPA and they put it in their tax software and they submit your tax return, right? They're not setting up businesses for you, investing in a 401k for you, or doing bonus depreciation for you. Like, they're not doing any of these tax planning tools, right, that you can be using. And I think that's a real disservice. It's so important to understand these for your own empowerment. And so you can start figuring out what steps you need to take to get your tax bill down, right? Outside of just, your CPA running your numbers all the time. And so that's what we're aiming to do, is to kind of simplify the tax planning process into something that is understandable, something that you can use moving forward, to really get a handle on what's happening with your taxes. All right.
Thanks, Susan. And I was just going to say, I know that we're at time if folks needs to drop, but we are happy to stick around for some more questions. I know that we had one question in a chat about installment sales, and yes, they do have different tax treatment. And I provided a response in the chat, but it's kind of hard to type through that. So we can totally circle back to that. Just making sure Tanya is still on the
Yeah, I'm
call.
here. I think
Okay,
I'm still
awesome.
trying to process your response. Thank you for responding.
Yeah, I don't blame
Uh,
you. An installment sale, that gross profit percentage that I referenced in that response, what it
uh,
does is it's calculating the amount of profit that you're getting on each installment in order to determine how much capital gains tax applies to that. So in the example that I used, if you're selling a property for say 500K, that's your sale price. But you also have to look at what was your gain in that sale. If your gain was 200K, then you would divide 200 by 500 in order to get your gross profit percentage. But then that is not your tax liability. That is the amount that is applied to each payment that you receive, each principal payment, to determine how much of this payment is going to be taxed. And then based on the amount of that payment, then you determine this is going to be my capital gains tax. So whatever capital gains tax bracket you're in is then applied to that amount. So it is a little bit more confusing. It's not like, just a regular capital gains tax on a property sale where you take, the full amount of proceeds when you sell a property. But it often is an advantageous way of going about selling a property from a tax perspective, because you're spreading out those payments and you're only being charged a tax on the actual percentage of your gain. So did that help answer your question at all, Tanya? Or even if you wanted to use a real example with numbers that
Right.
are more relevant to
Actually,
you, we can.
sure. Yes, I did sell a property on owner financing last year, but there is a down payment. So, like year one, right?
Correct.
Actual, so like you said, I understand the interest part that goes under the portfolio bucket, and the actual principal payment as part of this monthly payments is very low, as you know, right? Most of it is interest. So that part is not much, but I do have a big chunk, like a 10% from down payment.
Sure.
So would only 40% of that down payment be considered as the income for that year, capital gains?
That's correct. So it would be 40% just based on our example. So you would calculate what your gross profit percentage is. And yes, that down payment is considered a principal payment. None of that is interest. So that is where you would use your gross profit percentage to calculate how much of that you're going to be paying capital gains on.
And I also have some passive losses from previous years. So those should be able to offset this income, right? Like, do I have to like completely use every single passive loss that I have from other properties as well? Or can we limit it to just the passive loss from this particular property?
So typically the losses from this property are going to be used first. And then you can tap into losses from other properties and use those also.
Okay. So I can, but we don't have to, right? I don't have to use the passive losses from the other properties. Like if it doesn't make sense, like
you would typically want to. I would recommend using them. They will cancel out.
Yeah.
Again, it's the time value of money, right? So you're not paying the tax bill this year. You get to instead save that money and invest it in something else, right? That could continue growing.
Right. So the reason I was asking is I'm trying to think how to ask this. So my total income is going negative if I use everything. So I don't think there is a need to make it negative, right? I just have to make it zero. So that's the reason I was trying to understand, because my CPA has used every single passive loss I had, and I was wondering, why do I have to use when I don't need everything? And that's why I was wondering if we have to use every single thing I have, or can I just limit to what is needed?
Yeah, so anything will carry over, right? So it will technically go to zero, and then if you have extra losses, they'll just carry over to the future to offset more gains.
Right. Okay. Yeah, that was my main concern. Like, why are we making it negative, whatever, right? Like, I could use them in future, especially because I'll have income coming next year. I want to be able to use those passive losses from the income, the principal payments I get for next year. Thank you. Yeah.
And I always have a massive passive carryover loss. With the way my real estate is set up right now. I had a lot of syndication investments that did bonus depreciation back when it was 100% a few years ago. And so I still am just chewing up those losses, and I have sold properties and they still just keep eating the losses. And I still have probably 300,000 left in passive carryover losses. And so right now, I don't pay any income on like my rental properties, my long-term rentals, short-term rentals. Like none of that income is taxed for me each year. It's just using those losses. And when they get used up, probably what I'll do is invest in something else and take bonus depreciation and get those losses again, right? And just keep rolling it.
Yeah.
Yeah, and they shouldn't ever be going to like below zero,
Right.
Like
that's what I was thinking too. I'm like, maybe there is something I'm not following, because my CPA has made all the passive losses to zero. Like after whatever was done with this sale, I have passive losses of zero. I had like a big chunk too, like 120K or something. But now it's all zero. Especially when the income is going to negative, right? Anyways, I think I need to talk to her. Yeah, I'm still working on my last year taxes. if that wasn't clear.
No, those are great questions. I'm glad that you were able to identify that. Agree, that's probably something worth revisiting and just clarifying. Um, and I'm also seeing that Sophia is asking about a CPA, preferably in Texas, that we can refer you to. And it's sometimes it's rough to refer to CPAs because we always like to make sure that our referrals are people we've either worked with personally or really trust based on personal feedback from people we know and trust who have worked with them personally. And then a lot of times they wind up filling up their lists. But I think Texas, Susan, do you, I don't know if Katie's in Texas or.
She's in Arizona. She's who I normally refer people to, Katie Rip. She's in Arizona, but she works nationwide and she is amazing. So if you send us an email, we can get you her information.
Will do. Thank you, ladies.
Sure.
Yeah.
Great questions.
Hopefully this was helpful to you guys.
Yeah, it's really helpful. Thank you.
Absolutely.
Great. Yeah, I feel like this stuff can really be life-changing, to finally start understanding it and understanding how the IRS is setting up your tax buckets. All right. If there are no more questions, I know we're a little bit over time, but I appreciate all of you guys being here. This was really great. And we had our email there on the side if you need anything else. And otherwise, the recording of this will be up on our YouTube channel. If there's anything that you guys want to go back and review. All right.
Thanks,
See
everyone.
you guys later.
Have a
Thank
great rest of your
you.
day. See ya.
Bye.